Good evening, everyone, and welcome to the Journey to Multifamily Millions monthly webinar. I'm Tim Little, founder and CEO of ZANA Investments. We help high net worth individuals diversify their portfolios and get competitive returns by passively investing in multifamily real estate. As for housekeeping rules, please keep yourselves muted when not speaking. If at any point you do have a question, just go ahead and drop it in the chat during the Q&A portion. You'll also be able to raise your hands during that time, and I can go ahead and call on you. That way you can ask your questions live. And just so everyone knows, as I mentioned, this will be recorded, and I'll send it out to everyone as soon as it's available. Finally, I encourage everyone to put their contact information in the chat so that you can continue to build your network. Okay, with that out of the way, well, I would argue investing in real estate is one of the fastest and safest ways to build wealth. If you're not actively developing a tax strategy that leverages all of the advantages of real estate, then you may be paying more than your fair share of taxes. Here to help us fill us in on some of the top strategies we should be using, especially with recent rule changes. We have with us Larry Pendleton. Not only is Larry a CPA, but he is also an active multifamily real estate investor. So I would say he's uniquely qualified to talk on this topic, having been on both sides of the fence. In full transparency, he is also a friend of mine and my personal CPA. So it's really a pleasure to have him on and share some knowledge with us. Larry, welcome to the show. And without further ado, please take it away.
Appreciate it, Tim, and thank you again for the opportunity to add value, and thank you all for your patience. I'm starting the late stars on my end, so don't throw your tomatoes at me. But first and foremost, grateful to be here, based out of Norfolk. We'll get into introductions, but I'm really, really excited to help add value to those in real estate. I do see it as the main vehicle of building wealth long term, not just getting rich real quick from that standpoint there. And the stuff we'll talk about tonight will familiar for a lot of you, has already been in the game for a while, but we're gonna go a little bit depth, quite a bit there. So further ado, I have slides. I prefer to talk to you all more than than go through the slides. So please feel free to interrupt and have open discussions regarding anything that we're talking about, any questions that you got going on. And then, do everyone see my screen?
Yeah, from my side,
Yes.
it looks like you're in mode.
So there's a bunch of different strategies in tax savings in general, and even within real estate itself. But I really want to kind of hammer the two that the wealthy has been really taking heavy advantage of, and build upon that. From there, we can be all night talk about it. Tim rein me in a bit, and so we're just going to cover these two in particular detail. Hopefully, like I said, we'll get a lot of good questions going and keep the discussions free flowing. I'll do a brief introduction of myself. We'll talk about how your income is taxed from a passive and active standpoint. If anything just sounds familiar and I'm just kind of wasting everyone's time, like, please interrupt. There we'll discuss strategy one, strategy two, and then we'll get into the conclusion of the presentation. A little more background about me. As Tim mentioned, I am a CPA. I'm based out of Norfolk, Virginia, southeast of Virginia. I am senior partner of PC Financial Services. We do service multiple clients in various states. Our niche is real estate because, as Tim mentioned, we are also real estate investors, not just in Virginia, multiple states, done single family, done multifamily, short-term rentals, long-term rentals. So a lot of the strategies and stuff I typically tell people is like, I've already like put myself and my wife with me through the gamut of how to really take what you hear on YouTube and then really apply it based off what the tax code is saying. I'm very, very big on keeping things passive, and just as my investment strategy, I mean, there's still a lot of good strategy. You want to be active in the state, but I'm more in tune to be more on the passive side of things myself as I build my portfolio out. Disclaimer, the only person up here that is my client is Tim and Sam. So for everyone else, this is really more for informational purposes, hopefully some entertainment as well. I'm gonna try to keep it light as much as possible, but please like verify whatever I'm saying do your own due diligence, talk to your tax advisor. If you want to reach out to me and my team, you'll see a QR code on the top right on every slide. or onto my upper left shoulder here, where we're gladly to touch base, schedule your intro call, and start to see where we can be of value to you. So how your income is taxed is the premise of how the tax code is. Like they're very, very harsh on active income. Um, whether it's from a W-2 employee, self-employed individuals, because the tax code itself is truly made for big business owners and investors. And if any of the recent law changes haven't really proven that, I will point to the most recent student loan forgiveness. And people go to school, work their butts off, and they get $10,000-$20,000 forgiven from that standpoint. But then there's millions of dollars, hundreds of thousands of dollars given in PPP loans that was forgiven from that standpoint. So if recent news doesn't prove that you need to start kind of building your income from a different perspective, from that standpoint, it's going to be tough to ever really keep more than what you make. So that the term work smarter, not harder hits home, where as you're growing your profession and you're getting bonuses and raises, but you're getting taxed more without any relief. Whereas in real estate, the reason why I love it so much is because though it's people hear about Robert Kiyosaki, Rich Dad, Poor Dad, it's really that second book, cash flow quadrant. That's the big piece here, because as an employee, as mentioned before, like your income tax, is 30 to 40%, and your self-employed is even worse because now you're dealing with self-employment taxes. But as you shift more to that right side of the quadrant, now you're talking about 10 to 20% as a big business owner, because you got research development credits, you got payroll that you're paying, you're growing your business, making more money, but also able to get more deductions. And then as an investor, whether it's real estate, Warner, food, if you're investing, like the tax code opens up a bit larger from you from that standpoint there, because even if you're in the grand scheme of things, even small in real estate, you can still kind of take advantage of a lot of what you hear about the mega investors, entrepreneurs are seeing from that standpoint there. So, rather key to kind of be mindful of where your income is coming from, because investors and business owners still pay taxes. They just don't pay as much as income taxes, because the government wants to incentivize those that can to help build the economy, build the nation, keep things innovative from that standpoint. Whereas an employer, self-employed, you're more just kind of benefiting yourself from that standpoint. So they don't really provide too much tax data from that standpoint. If I'm going too fast, let me know, slow down. I want to make sure that I feel like this is the base of your understanding of you and or your tax advisor have to be kind of seeing the tax code itself, so that you can kind of reassess and start to strategize where you want, where you're going to be kind of investing money into. First and foremost, is a good investment. And then secondly, then get the tax savings there. As I discussed before, part of how your income is taxed is that your passive income, the reason why it's not taxed as harsh is because you don't have to deal with self-employment taxes. The IRS does not deem that as active. You don't have to contribute to Social Security, Medicare, FICA tax buckets from that standpoint there. So you get similar deductions as a big business, so you can still write off the mortgage interest on your properties, mileage, basically any business expenses that you're incurring for your real estate. Because I hear a lot like, what can I write off? Like if it's a necessary or ordinary expense for your business, you can write it off for your rental property as well. So it's trying to expand on people's minds about that. As noted, like I said, you got that 15.3% self-employment tax that you don't have to deal with, and that alone saves people thousands of dollars of taxes from my clients, and for other people as well. It's just, okay, are you able to build the cash flow for it to make sense for you from that standpoint? How you're going to adjust, especially if you're going to try to adjust out of your W-2 or close down a active business that you're running from that standpoint there. And then there's additional tax strategy opportunities within real estate that you don't really catch in other industries, or other industries basically having to pull from real estate in order for someone to still benefit from that there. As I tell people, you make your money with your business or with your W-2, because as we all know, as investors, the income coming in from whether even if it's a single family home up to a 100 unit apartment building, like that's rolling in slowly. Like you're not living in beliefs off of just one property. You're having to build and grow from there. But you can use your real estate to create those tax strategies to keep more of what you make. And then we'll start diving into some of these strategies from the standpoint here. Everyone I still got everybody good to go. Questions so far?
No, Larry, the only thing I would say is that people try to demonize taxes or this and that, and that I think the main point is that taxes are simply a way for the government to either incentivize or disincentivize behavior. So, if these, millionaires, billionaires are getting, tax loopholes, whatever you want to call it, these are things that are part of tax law that they are taking advantage of because they are doing things that the government wants them to do, whether that's creating jobs, creating housing, whatever the case. So I just think it's important for people to realize that, like, you're not like getting over, you're doing exactly what the government wants you to do. That's why they're giving you these tax breaks.
Yeah, it's said one of the most American things you can do is follow the tax code, because if you're doing that, you're providing a huge benefit for the country, and because you're taking on the risk of investing into a 50-unit apartment building or whatever size of it. So it's like, okay, that's not just benefiting you, that's benefiting everyone that can live in that building. That's benefiting all the people that will work for them. So you're creating jobs, you're creating housing from that standpoint there. So that's really what kind of starts to create the divide between um just kind of everyday tax preparers and your advisor. So you just want to be mindful of, if your advisor is kind of scared to kind of look at what the code is saying, because the code is just trying to get you to move a certain way. They want people to provide housing, they provide low income housing tax credits and depreciation, or they just want people to buy houses. They let you write off your mortgage as an itemized deduction if you can even qualify. They want you to go make sure you get Medicare attention, so that you get a Medicare medical deduction. So it's just like, even from a personal standpoint, they're trying to incentivize people to do certain things, donations. It's just, those are pennies in the bucket when you're talking about how they're trying to incentivize investors and big business owners to move a certain way. So great point there, Tim. And then, like I said, the first strategy that the wealthy is using, how can they maximize depreciation from their buildings? As most people up here are real estate investors already. You're already familiar that you're able to kind of take 27 and a half years and recognize it on an ongoing basis. Um, and so I don't want to get too deep into what depreciation is. It's kind of put up here for informational purposes, but you're just allowed to recognize that cost over a certain period of time. And there are certain benefits associated with that, where not all tax deductions have to deal with, hey, you have to pay money come out of pocket. From that standpoint, it becomes a little counterintuitive if I have to keep paying money over and over just to save on taxes. Is there a more cost effective way to do so? And depreciation is one of them, where forever cost $1 million property, you're only going to put 20% down, but you get the full 100% tax benefit of depreciation. So that's where it becomes rather beneficial, where you just have, and I say I never recommend it, but I've seen people just buy properties just for the sake of getting the losses so they can offset other income from other properties and other businesses. And I'm not a fan of that. Like I understand, but it's um it's just kind of limiting. Was like, okay, you should be investing, making sure it's a solid deal first, and then try to factor in the tax strategy behind it. Um, to that point was like you have the opportunity to just kind of wipe out a lot of your rental income. And as high net worth individuals, you're always dealing with this tax issue related to your job or your business. Whereas the the passive losses from or the deductions that depreciation creates can actually wipe out your rental income where you got nothing shown, where it's like, okay, you may still be paying taxes, but you actually made more money than what your income is showing. So that's where you start to see your overall effective tax rate start to drop, where you may be in that 10 to 20% or 0 to 10% effective tax range, based off of the fact that you're not paying any money, paying any taxes on the money that you're earning from your rental properties. And then I said potentially even going out into like losses, and then maybe even able to offset some of your W-2 and business income. But we can, like I said, we'll cover that down the road. And then the hot button, the special of the past 5 years, and especially this year, is cost segregation studies and how to use those to then offset, to create even more deductions in on your from your rental properties, and then to offset your more income there. So I want to dive a little bit further. Any questions on depreciation from anyone, before we kind of drill into cost irrigation studies?
So this isn't cost segregation or depreciation specific, but Ray did have a question. I think it was reference to your previous slide. It said, what's the difference in structure between self-employment and a business?
Yeah, so great question. Let's take it back. So self-employed is basically single member LLC. You can't take a payroll. Even if it's a partnership, you can't take a payroll because the government is attaching you to the business itself. So any money that you take out is equity from the business. So whatever your net income is, you're going to be taxed on that. In addition to that, you're going to be hit with self-employment taxes. As a big business owner, you may be an S corp election, you may even be a C corporation, but you're hiring people, you're developing new products, you're buying more or buying other businesses or buying other franchises. So you're actually outsourcing more of your work. Where it's like, okay, the income from the business is jumping up high, but then your salary is what is a particular set amount that's deemed reasonable how the business is running. So really the difference really is that are you truly an employee of your business, or are you the business itself? Because if you're the business yourself, then you're going to be hit with all the taxes that the business is making. And then as you can't continue, because a lot of people try to game the system and show a loss for their single member LLC or their partnership. But at some point, the IRS expects businesses to be making money so that you are contributing to the Social Security and Medicare buckets, whether that's around or not. in 30 years, who knows? That's a whole nother topic of discussion. But hopefully, Ray, that answers your question. From that standpoint, there, look like I got a thumbs up. I'm always here for the thumbs up. Thank you, sir. Let's jump ahead again. Boom. Some silly slides, all that stuff. Great. Um, so over the past 5 years, cost segregation studies have been very, very popular. Um, but they always been around because there's always been some type of bonus depreciation associated with associated with rental property or just properties in general, or business properties in general. So what created the popularity over these past 5 years is with the Trump tax changes in 2017. Basically, anything that depreciates less than 20 years can be fully depreciated year one, which creates these huge losses. When you're talking about rental properties, the standard process for most accountants and tax preparers is just to take that cost for the property, break out the land portion, and then depreciate that amount over 27 and a half years. Great non-cash expense, but it's good, but we want great. And that's where the cost segregation now becomes even popular, because now we're saying, hold on now, out of that $1 million cost basis for that apartment building that Paul bought, not all of that is 27 and a half year property. Some of that is 5-year property, some of that is 15-year property. Those are mostly that they could be 7-year property, they could be 10-year property. But the two main ones is 5-year, which you have carpet type of flooring, ceiling fans, certain appliances, furniture and all that there, versus the land improvements, which is your 15-year property. So parking lots, pool, driveways, patios, decks, fences, breaking those components separate from the building itself, which is all considered 27 and a half year. And the building itself, like the roofs, walls, um sometimes with windows. So like we're creating these different buckets on the tax return to take advantage of the time value of money concept, because now we're recognizing more upfront, because whether it's inflation, all that's going to continue to increase. Dollar value is always going to be lower. Like it's always going to be more cost advantage to take advantage of deductions now, if you can, than just to kind of ride it out over a limited period of time. And that's part of what the IRS wants, because it's incentivizing investors to buy more, to trade more, because you can depreciate faster because you got 5, 7, 15-year property. But now you're able to even do 100% bonus that ends after 2022 in year one. It doesn't end, it just starts to kind of sunset and phase down 20% over the next until 2027, 2026. But we're expecting in the CPA community, there's going to be some legislation that probably comes out 2024, 2025 to possibly amend it, because before 2017, it used to be 50% bonus depreciation. And like I say, they just kind of put steroids on something that was already pretty strong for investors from that standpoint there. So that's one of the benefits, how we can maximize depreciation with the power of the cost seg. The cost seg also allows for asset disposition. And what and that particularly means is that there's an opportunity to mitigate your depreciation recapture on the back end. For those not familiar with depreciation recapture, is that depreciation itself is only a loan for the government. It's a binding contract of, okay, you're buying this rental property, you're providing a service, you can get this deduction. And we'll keep this agreement in place as long as the appropriate depreciation periods are in place. But as soon as you sell that property, you're broken your contract with the government, and now we want that depreciation back, because we're going to give it to the next investor. So that's where it's like, okay, if you're going to break it, do you have a plan to then offset it, possibly doing more, getting more properties, getting depreciation on those to help offset the gains? 1031s have always been around. Like I said, we won't really get into 1031s much tonight. We can talk about it, but it's not really part of the presentation, but that's another option there. But now you have to deal with this additional gain on your property that you wasn't aware of, because you have to pay back this depreciation. Asset disposition helps out, because if you're replacing certain components, if you have replaced the roof, now you're able to write off that fully old value, the value of the old roof of that 100-unit apartment building that you bought, and get that deduction. And now you have a new depreciating roof, so that if you did sell, you don't have as much depreciation on the back end to deal with. So that's part of, and then having these components broken out kind of helps with, like, hey, when can we write this thing off our books, so that we can focus on something new and mitigate the back end. So it's providing an initial benefit up front, and then also providing potential benefits throughout the whole period of the property, as well as on the back end when the property goes full cycle. I think a question came up and didn't want to get too far off without addressing it. Paul, is depreciation, you're speaking of, limited to the amount of equity you have in the property? So not much depreciation itself. Great question, Paul. So depreciation, really, when people hear about the limitations of losses, that's from the property as a whole. Depreciation kind of as a factor is another expense line item, whereas you could have a loss from the property with no depreciation or with very low depreciation, but you may be limited to how much of that you can claim if you have no equity or no basis in the property itself. Basically means a lot of GPs kind of go through this, when they get all the capital raised, they don't put any money in the deal, they don't get the right type of financing in order to get basis in the property. So they're not able to use these losses because the IRS deems that like you have put no risk associated with the property itself. You have no money in the deal. You may have some very little credit involved, but you didn't get the right type of debt. So for obviously LPs put money in the deal and they potentially can use those losses. GPs potentially can, one, they put money in the deal, or they get what's called qualified non-recourse financing, or just non-recourse financing, and that helps give you basis or some equity in the property itself in order to be able to claim these losses, or potentially be able to claim these losses that depreciation typically covers. Hopefully I addressed your question, Paul.
Hey, Larry. Yeah, that makes a lot of sense. I'm sure Paul will let us know if he needs more clarification, but I had another point, I guess, that I wanted to hit on this asset disposition piece so that I understand it. You're saying if the depreciation recapture is essentially 1-for-1, the depreciation that you've taken over the course of, say it's 5 years, just as an example, that total amount is going to be recaptured at the point of sale. With this asset disposition, what you're saying is, say you took $10,000 for a roof, but then you replace that roof, that can offset basically the depreciation recapture.
Yeah, so part of that is that it's an initial benefit of the period of you replacing the roof. So in your example, $10,000 roof, let's just say that it was $5,000 depreciation accumulated during that time of you holding it. So if you would have sold that property in that year, you would have to pay back that depreciation that you claimed on it. But if you replace the roof, now you can't depreciate two of the same things. So we're now writing off the value of the old roof. So if there is depreciation, if it's not fully depreciated, you actually get a deduction that year because there's leftover value. If it's fully depreciated, it's just a wash on your P&L, but it removes it off your balance sheet, so you're not paying back depreciation on that roof. But on the new roof, let's say you had to replace the roof in order to get the sale, and now you got this new roof in place. You may have sold that year or the year after, but you have less depreciation to recapture on that one. So now you're not dealing with as much of a gain to deal with, because now you're dealing with a new roof that you sold the property a lot sooner. So that's where actually doing renovations on the back end could be useful. Like I said, if the costs all associated with it makes sense and outweighs all the hassle and stuff, or make sure you got the proper sale in place and getting the type of returns that you're looking for.
Okay, yeah, that makes sense. I mean, obviously, don't go double over your CapEx budget just because you're trying to avoid depreciation recapture. But if it's part of your overall business plan anyway, it's beneficial in that sense. Besides it being part of your overall plan, it sounds like it helps you with that depreciation recapture piece. And I guess the only other thing that I wanted to mention was you talked about that depreciation being potentially passed down. in my experience anyways, with the LPs, the passive investors specifically, that's something that we always do. And we do that through a K1 that is pushed down to them. When a K1 would have, whatever distributions they might have gotten, but we also pass down that depreciation so that they're able to kind of offset some of the distributions that they may have received.
Yeah, and part of that is how the operating agreement is set up and how it's being pitched to investors. Because you can allocate per your operating agreement 100% of depreciation to your investors. So the GPs don't really. So it's all about, okay, how do you want to sweeten the pot in order to get someone to invest into your deal? Now, the cat's out of the bag a bit because operators have oversold the tax benefits of depreciation. And then a lot of LPs that end up coming to me because they think their CPA isn't doing it correctly. It's like, no, like you don't qualify to take these losses. And we'll go into that in the next strategy, but it's making sure you're getting the full picture of what the GPs are offering, and then if you can even use it as a benefit to you in year one. Not saying you can never use it as a benefit, it's just there's a timing aspect of it. And it's not always clear from a GP who's basically they're using a tax advisor. They probably don't have their boring tax advisor talking on the webinar because that's not sexy. That's not going to drive people to go subscribe to the deal. So it's just being mindful of you may have to have these one-on-one conversations with your advisor as well as with the GP of, okay, what I'm expecting to get, and let me see if it's even going to be beneficial. But once again, don't let the tax tail wag the investment dog. If it's great returns, like don't let the fact that you're not going to be able to use losses to offset your W-2 skew the fact that you're going to make a good return on this property and you probably won't be paying taxes on that income in the first few years because you'll still have those losses built up because they'll be suspended and roll forward into future years. And then once the property goes full cycle, you can use those losses that you couldn't use to then offset the capital gains on the property when the property is sold. Cool, good stuff. Great questions. Let's just do it. I just like my Big Mac analogy when it comes to cost segregation. Like straight line, you get straight $3.99. Break that over 27.5 years. But cost segregation study, that's when we go with the song. To all beef patties, extra sauce, lettuce, cheese, pickles, onions, and the sesame seed. But I know someone is a little nostalgia. It can't just be me. So, but this is basically what the cost segregation is doing. Where it's like, okay, they're all beef patties. Okay, that's your 27.5 year profit. We can't fully depreciate that, but we possibly can do the onions, and we can possibly rob the pickles, which is creating a larger deduction than what you're getting just doing straight line of the full $4 burger over 27.5 years. Now I'm hungry. And then, so here's just one example of a cost segregation study I did for a client. I think this one earlier this year. So things to kind of point out is that we got nearly $60,000 of additional tax deductions year one. It's important to highlight here, like there's a difference between tax deductions and tax savings. Tax deductions is just like, hey, you get this, you're going to reduce your taxable income by $60,000. That doesn't mean you're saving $60,000 in taxes. You just have a lesser income. And depending on your effective tax rate, which is based on all the components of your tax return, your tax savings is always going to be lower than what your deductions are. So in this case, for this particular client, they got $60,000 deductions, but is only going to show $18,000 of tax savings, which is still huge. Like I don't want to completely disregard that, but I just feel more comfortable knowing that it was properly explained that there's a difference between like why I didn't get a $60,000 refund, because like it doesn't work that way. So this is kind of the 5 and 15 year property down here that I was referring to. So still majority of the property, you'll still get depreciation going forward Because a lot of questions I get is like, is this a 1 year thing? It's like, yes, it's really a per property because you can buy multiple properties and do cost segregation studies on all of them. It's just you'll get the 1 year benefit, and then the rest, like this nearly $60,000 you're going to be able to claim in year one, and then the rest of this 166,000 you're going to depreciate over 27 years. So there'll still be some depreciation, but to my point earlier, the tax code is set up where it's like it's almost like a drug. You got this big hit, and now you're chasing it after that, which requires you to buy more properties. Questions on this? You'll see something like this from like Mass and Specs or CSSI or any other cost seg firms. Everyone has their own little versions of it, but it's all kind of basically the same. From that standpoint, you really can't go wrong. I haven't really heard much complaints, and I've dealt with like 7 different cost seg companies across the country, and all of it is about the same. It's just, do you have a good rapport with whoever's selling you the product, and just trying to make sure you're not being oversold from that standpoint.
No, the only thing I would say is that, referring to the conversation we had earlier, I think it goes back to, as an individual, you need to make sure that you have a tax strategy, not just do your taxes. Because if you're investing in stuff like this, yeah, you may have like a 3 to 5 year time horizon, but you need to be cognizant of when that capital event probably is coming up, when they're probably going to sell, because that's the time when you want to start looking for another deal so that you can get that bonus depreciation that's hopefully gonna to offset that big capital event that you have when that property does sell, and you get a big fat check, which is all goodness. But at the same time, you still want to try to offset it as much as you can by, again, having that bonus depreciation from the next one. Or if you had some stored up over the past 3 or 4 years, that's great too. And then for us as general partners, the ones who are putting these deals together, again, like we talked about, it's having that transparency with our investors and making sure that we keep them informed to say, hey, I know we said we were going to sell in year 5, but it's only year 4 now, but the market looks great, and we think that now is the best time to sell. So we wanted to give you a heads up that that's probably going to happen. Give your investors enough time to react with their own tax strategy, so that they're not blindsided by this good capital event, but still a capital event. And if there's preparations that they need to do with someone like you, their CPA, to better plan for it, they have the time to do that. And I think that's just something that, like, I certainly hadn't really thought about. Obviously, we're communicating with our investors all the time, but I guess I hadn't really thought about it from the perspective of, hey, let me help this person out for their individual tax situation. They need to know as soon as possible if you do plan on selling, because it's not just impacting them. It's not just impacting you. It's going to impact all your investors, and you don't know what their specific tax situation is. So sooner the better.
And that goes along to piggyback off all the great stuff Tim just said. Like, it's going to go a long way when you're building that rapport where, like, okay, they feel like if this person is looking out for me, I feel more comfortable reinvesting with these funds instead of you having to try to find new investors. Like I said, if you're able to keep that nuclear base that you have, it just makes your next capital raise a lot easier, from my experience as well. So awesome. Keep it moving. So tax strategy number 2, like, I really wanted to get into 1031s as number 3, but I really wanted to hit real estate professional status and material participation, because if I'm comparing that to 1031s, it's a 70-30. I'm hearing about questions on real estate professional status in material participation, because it's missed in so many areas, and it's really where the wealthy is kind of positioning themselves to maximize the losses from a cost. So I wanted to dig a bit deeper and help clear up the misconception of these which I'm pretty sure everyone has kind of heard of, like a real estate professional status, like annual election, and what then the overall goal of rep status is that you do not want your passive losses to be treated as passive. You want those, you get this K1, I've seen it multiple times where they got 5-figure losses, sometimes even 6-figure losses on their K1s, and they can't use it because both spouses are W-2 or it's a single person and they're running a business. I'm a victim of it. Like, I'm an investor, but I spend more time in my tax business than I do with my real estate portfolio. Like, I outsource everything. Like, I'm not managing anything. I'm gonna be completely honest, very passive. So like, even I like having like get stuck in this world as well because I'm not actively involved in running a real property trader business, and I'm not materially participating with the day-to-day operations with my properties. Like, people hear about reps, but they don't really get into material participation because it's not as catchy. But a lot of times you got your material participation and your reps are the same type of hours, but it's just, can you qualify for both? And then once again, IRS deems rental real estate as passive. Most of us are just kind of collecting mailbox money. There's a property manager involved. Like, you're not really active. They don't really perceive it as active, even though those that does this, like, we're pretty aware you're not sitting back, not doing anything, but the IRS still kind of deems it to be passive. But there are ways to create these exceptions, and real estate professional status becomes that from that standpoint there. And as mentioned before, even if you can't use it in the year 2022, it doesn't just go away. It just kind of sits in purgatory, waiting to offset future passive income or passive gains. Now, a lot of people don't want to hear that because they want to offset their W-2 and their business. Okay, well, you can't, but you'll still have a benefit because eventually all syndications go full cycle. More likely than not, they're going to be selling the property, not just refinancing and pulling the money out. So you'll be happy to have these losses to offset these future gains going forward if you can't qualify real estate professional status and material participation. So, as asked before, this is one of the exceptions. And like I said, I want to kind of go deeper than how do you qualify for these things, is how the wealthy is taking advantage where, like I say, even if like from a married couple perspective where, okay, the one spouse is working, other one's staying home so they can commit the time to reach the status. It's not a job title. It doesn't matter if you're a real estate agent or a real estate broker and you pass the test. Like, all that means nothing if you're not putting the time in. So married individuals, I've seen them kind of like they'll just, one would just quit their job and it's like, okay, they're just focused on this and they get a mini break because their income dropped, but now they have more time to invest in their portfolio and they get these losses. So they're kind of building back up their portfolio. And I've seen like individual business owners shift their work schedules in a way where, or their business schedule where they're putting more time in their real estate than their main business. And that's where kind of the big business aspect of where like you're not hiring people to outsource stuff. You're not so involved yourself where you're kind of wrapped in all of your time from that standpoint there. So a lot of times people hear about the 750 hours, but it's the more than half your work time that ends up tripping people up, because it's like I say, if the average person is working 2,000 hours a year with their W-2, it's tough to tell the IRS you're working 2,001. I think my 3-year-old is about to kick my door in. So that's where you want to make sure you're tracking your hours of not just what you're doing for real estate, but also what you're doing for your business, your W-2. Because if you are audited, the IRS is going to check that from that standpoint. It doesn't have to be property management. It could be construction, could be management, could be acquisition, stuff like that. Not saying it's impossible with a W-2, it's just rather difficult. And material participation is rather similar to real estate professional hours. It's just that the job/business component is not a factor. It's truly all is based on what you're doing with the day-to-day operation with your property. So whether you're doing all the work yourself or you have 100 qualifying hours and more than anyone else, which is rather difficult for GPs because everyone's trying to qualify. So it's like if I work 110, Tim is like, well, no, I'm trying to get this as well. I worked 101. We're just gonna keep playing this game back and forth, but who's gonna one up each other? So that's where the 500 qualifying hours comes into play. So what I've seen the wealthy do is, like, as I mentioned before, they'll get their spouse more involved. And I'm talking about really seriously involved. They just can't just be boilerplate from that standpoint. And or they're just shifting their schedule and trying to do more real estate than actually with their business. And that involves building their business up a lot further.
And just for the audience, yeah, this is something that I'm certainly interested in when it comes to the real estate professional status, because this is something I'm pursuing for this year. I think the key aspect to this for people who are interested in it, who think they might want to become a real estate professional, is that the biggest benefit is if you're married and you file jointly and you're able to get real estate professional status, if you have enough losses, they can write down your spouse's W-2 income. Whereas if you don't have real estate professional status, then you're only able to write down your passive income, and then in any remaining will just simply roll over, like you said.
Kind of picked up where we left off. Questions on reps, material participation before we move forward.
Just on the material participation, use the example of like being a GP on the deal, but it's not like it's a by deal thing, right? If I've worked on several deals that year, it's just a matter of me tracking the total number of hours that I did stuff that counts towards the real estate professional status. Is that correct?
Yeah, great question. So really, we end up grouping activities at that point, where it's not going to be 500 hours per property. We're really talking about without getting too deep, it's a 469-9 election where we're grouping all your activities from all your rentals, for all the rentals that you're doing, so it makes it a lot easier to meet that. I have a client who has 60 single family homes. God bless her soul. But her material participation is actually spread out throughout all the properties. And it's like, okay, she doesn't have she's probably spends like 10, 20 hours a year per property, somewhat involved, not really much, but she checks the box from that standpoint so that she got the rep, she has the material participation, and she's all good to go there. Another benefit of it is that you and your spouse, if you're married, can contribute to material participation. You both can't contribute to reps. Only one of you can be a real estate professional, but both of you can prove material participation. So that's where it becomes a lot easier from that angle there. So, but yeah, there you'll be able to group those activities. So those, like I say, those are the two main things I wanted to cover tonight. I mean, there's so much more, but like I said, we're just kind of getting into like now what, like I'm always gonna be real big on consulting with professionals, whether from a tax perspective, legal perspective. This is a team sport. Real estate is just like with life. The more good people around you, the better. That helps you put a plan in place, and then you can go out, execute that plan with your team, and reassess where you can improve from there and learn from. And I'm really big on this quote because a lot of us got into this really to get our time back. I know I did with real estate, so I'm comfortable saying a lot of people are in the business for the same reason. So thank you again. Appreciate it, Tim, for this opportunity. Like, I really do it for these two knuckleheads. He's all right mopping. He likes doing it. Don't call the child services on me. He's okay. See, he's fine. But happy to answer any questions. Happy to connect going forward and go from here.
Yeah, no, I was just going to say I've seen some pretty innovative strategies about hiring your children and using that as a tax advantage as well. So I see you're putting that to use right there.
Yeah.
Um,
Yeah. So I try to max out that 12,000 as much as I can.
yeah, no, I just want to open it up first for questions before I close it out. If there's no other questions, obviously you guys can reach out to Larry or me if you guys do have questions. But first of all, I just want to thank you. This has been great. I know I learned a lot, and it also left me with a couple of questions and concerns that I will address directly to you. Again, a ton of great information in here, and I think it would be very beneficial for everyone if we could have you on again sometime in the future, maybe dive into some of those other strategies that you spoke of. So please let our guests know one more time where they can find you. I know some people showed up maybe after you had mentioned that up front.
I'll put my contact information in the show notes or in the comment section. What's the show notes? Wes. All the times you want to act up now in front of company. It's always in front of company.
Hey, and I think I have this presentation, don't I? I should be able to
Yeah, this
set
got
this
the
up.
PDF. You got the PDF version of it. I didn't make any changes from what you've seen. Great. So yeah, so you'll get all my contact information on that link or the QR code above my shoulder. If it's fat head isn't covering it up. And then yeah, happy to connect with anyone on the call. Like I say, grateful for the opportunity to add value. And yeah, I'll be glad to talk about more strategies that potentially everybody can use going forward. There's a lot out there beyond just cost irrigation studies and all that as well. So the main thing is to make as much money as you can and pay as less taxes as possible.
Yeah, absolutely. And I'll make sure that I have that contact information when I shoot out the email with the recording for this. Well, all right, everyone. Thank you for coming. I appreciate you spending your time with us on Wednesday night. Next month, we'll have an expert on solo 401ks and self-directed IRAs. So look for that in your email within the next few weeks. And if you want even more content in the meantime, I also have a weekly podcast called Journey to Multifamily Millions. So please check that out and subscribe and leave a review if you are so inclined. Thank you and have a good night, everybody.